Hi, dreamers. We talk a lot about the equity market, and I cover the stock market in depth. But one thing I rarely talk about is the debt market. And with the macroeconomic conditions changing rapidly, I thought it might be a good time to cover a different part of the market and take a look at a couple of fixed income options that you might be interested in to balance out some of the risk in your portfolio. So today we'll be talking about the debt market, some fixed income options, and how I am including these and adding to them as I rebalance my portfolio. Are you ready? Okay. So the first thing I wanted to talk about is the fact that I think we've all gotten too used to having most of our portfolios being equities. But in reality, there's the equity market and then there's the debt market. And just to level set us, in the equity market, investors buy shares of a company, while in the debt market, investors lend money to a company. And so debt investments have a fixed or predictable return, while equity investments can have a high return but also highly uncertain. And I think a lot of investors have lost focus of that old traditional 60-40 portfolio, which were so common in the 80s and 90s, because essentially a series of bear markets that started in the 2000s, coupled with historically low interest rates, really eroded the popularity of bonds, which have not done well in recent times due to those factors. And another factor for investors was the explosion of digital technology that had better growth profiles than that traditional 60-40 mix. But by this time, you've probably noticed that Warren Buffett has put quite a sizable amount of cash to the side, and your portfolio likely has been a little up and down as we've entered this year. And so although I'm not quite as doom and gloom as this analyst, he does have some interesting thoughts here. In his article, Spy, Be Like Berkshire and Buffett and Get Your House in Order for the Reckoning to Come. And in here he talks about the fact that the stock market might experience low returns between 2025 and 2035, potentially becoming a lost decade for investors. And a big part of that is the high valuation that's already priced in to some of these tech stocks. And that Buffett's selling as well as negative forecasts by major investment firms prefigure a decade in which underwhelming returns may cause investors to fail to achieve goals and dreams. And here's the key thing, that investors should lower their expectations and not reach speculatively for returns the market doesn't provide. And that because of these reasons, bonds and CDs may outperform stocks, and value stocks might start to beat growth stocks, in addition to a rotation to foreign stocks, which we've already started to see quite significantly, away from the US. And let me tell you, that's a tough pill to swallow if your financial advisor starts to tell you you need to lower your expectations. Wow. And this particular author goes on to say that the largest firms have been reluctant to go out on a limb, but he points out that this year most major investing firms were at least courageous enough to be somewhat conservative in their estimates of future 10-year returns. And so here you see Goldman saying that a 10-year real stock return might be 3% or less annualized, and Vanguard saying that an overall stock forecast of 2.8 to 4.8% annualized for 10 years is their forecast, which is lower than their 4.8 to 5.3% return on bonds. And so that's why, dreamers, I thought this could be a great episode and good timing to talk about how to reacquaint yourself with bonds and CDs. And maybe in the future, I'll do a dedicated video on how to create a CD and bond ladder individually. And let me show you one more article before we go into the fixed income instruments I want to show you as a possibility to add to your mix. I thought it was interesting that in this Seeking Alpha article, the author pointed out that previously we existed in a Goldilocks period for BDCs, or business development companies, where they refinanced their fixed rate debt at extremely low rates and then benefited from the floating rate loans that they issued. The Goldilocks period has ended for BDCs, and many of them are either redeeming their debt or forced to refinance at these higher rates, while the loans they are issuing out are seeing declining interest income because interest rates are starting to fall. But that interestingly, what this has caused is an inverse scenario for debt investors, and that previously, debt investors were on the losing end of the stick because interest rates were rising while they were holding on to their bonds that were issued at low rates. But now, debt investors can see success from the discounted bonds they hold or buy as rates fall. So with all that said, what I want to cover today is Pimco's CEF options. And as a quick reminder, a CEF, or closed-end fund, is an investment company that raises capital through an initial public offering of a fixed number of shares, and then invests that capital in a variety of securities, like stocks and bonds, which are then traded on the stock exchange as a basket. And so now let's talk about Pimco. And if you're not familiar with them, they've been around for a very long time, have almost $2 trillion of assets under management, and over 3,000 employees. So just a massive, massive company. And what that does is it gives them scale and access to be able to leverage their deep relationships with issuers and provide traditional and alternative investment solutions as a financing partner around the world. And so with that in mind, you can go to their website, and under investments, you can choose closed-end funds. And then in addition, under asset class, you can choose fixed income. And then you can get even more specific. But for now, I'm going to show you some of the flagship products, PTY, the PDI, and PDO. So as you navigate to the individual fund, you can easily see the statistics across the top with the daily market price, the premium or discount, the fact that it's a fixed income corporate for PTY, and the number of shares outstanding. And if you scroll down, you can see that the distribution currently is 12.18, and the expense ratio is a little bit high at 2.36%. And I'll show you what you're paying for in a minute. And here's the second one I'm going to compare for you, PDO. You've got all the key variables up here at the top. This one is fixed income multi-sector. It's got a distribution rate of about 11% and a much higher expense ratio. And finally, PDI, also a fixed income multi-sector with a 15% distribution rate and also an expense ratio above 6%. Now here's how those three funds have performed over the last 3 years, with PTY in the lead at 35% total return, PDI at 31%, and PDO at 24%. And it's not surprising that these are pretty bad, given that if you understand the bond prices and interest rates, they work inversely. So when interest rates rise, bond prices generally fall, and vice versa. So the thesis here is that if we expect interest rates to ultimately fall from the levels they are at today, these bond prices should rise in the future. So when we look in Seeking Alpha for PTY, and you see something like this, where the price was at one point over $21, but steadily came down over time as the interest rates increased, down to a low of about $12. You can see this leveling off period right in the $14 range. And so my thesis is that now might be a good time to add some of these fixed income products from Pimco, like PTY, PDO, and PDI, ahead of an eventual interest rate decrease. And I also wanted to show you the dividend history, because all of these three funds are monthly payers. You can see they're steady payers, so you can count on income that doesn't fluctuate. And in some years, you get a special dividend at the end of the year. And so what are some analysts saying about these three funds? Well, we're starting to see headlines like PTY is a haven in a volatile equity market, and the kinds of things that I've been pointing out, like recent market volatility underscores the need for diversification and non-correlated assets to hedge against downturns. This article points out that PTY's flexibility and asset allocation, including high yield and emerging market debt, and reduced leverage has driven strong performance amid market stress. One of the things they point out is that the fund's outperformance of the broad bond market and money market competitors highlights the manager's success in actively managing this fixed income portfolio over long periods. One of the things that they point out is the ability for Pimco's management team to be flexible with their approach. And that while these funds are fixed income oriented, their asset allocations and nuanced investment strategies can change quickly to adapt to current market conditions. So let's take a closer look at these funds to see the difference between them. And one place you can do that is if you scroll all the way down to the bottom, you can actually see this section of all documents and this little download of holdings, which if you click, brings you to something like this for PTY. And here's where you can see the exact holdings and breakdown. So you see the loans that they have, the rate, the maturity date, exact amounts, and what the percentage is of net assets. And you can see all of those specific loans and may even see things you recognize like JetBlue, SanDisk, and Veritas. And as you scroll down, you can start to see their corporate bonds and notes like Deutsche Bank. And as you continue to scroll down, you see all of the different bonds that they have. They've got British Airways, Boeing, Air Canada, Nissan. So these are some of the things you should recognize. You can see different utility bonds. And then as you scroll down, you see different kinds of debt. You see municipal bonds and notes in Arizona, California, Michigan, Puerto Rico. Then you see some of the U.S. government agencies like Fannie and Freddie Mac. They've got non-agency mortgage-backed securities, and there's a bunch of those in here from JP Morgan, SunTrust, and WAMU, and so on and so forth, down the wide variety of debt instruments they use to make up their total net assets. So now you know what you're paying for in those management fees, but instead of going through each one for PTY, PDO, and PDI, let me break it down for you and make it easier to take a look at this. If we take a look across the sector allocation, you can see key differences in the percentage of U.S. government-related debt held, which is higher at PTY, versus the CMBS and non-agency mortgage assets, which are higher in PDO. You see more non-U.S. developed debt in PDI, yet more high-yield credit debt in PTY, and investment-grade credit in PTY. And so as you're considering adding some of these fixed income options into your portfolio, it's important to take a look at some of the different mix elements across these gigantic fixed income CEFs. And so I know that was a lot of information and gives you a lot of places to take a look at as you're considering potentially adding some fixed income to your portfolios. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.